All right, now, philosophically now, there's general debate about the attractiveness of Africa as an emerging market or frontier market space, whether funds are coming fast and furiously into Africa or preferring to go into Asia and probably Eastern Europe. What's the experience of your company been?
I think if we just focus on Africa, because that's where our area of expertise is, what we're seeing at the moment is quite an unusual situation where you've got companies with excellent growth prospects and limited downside risk, yet providing exceptionally good dividend yields of over 10%, which is quite unusual in financial equity markets, because typically you're either going to pay up for growth or you're going to take lower growth prospects with the higher dividend yielding companies.
So basically you're saying Africa is the place to be. Right, so which sort of companies are you looking for? Because many people would say, you know what, with the exception of FDI, it's really difficult to direct portfolio flows in Africa. Capital markets are underdeveloped, not a lot of dynamic companies listed on various stock exchanges. It's just a very difficult environment to navigate.
Yeah, I'd make a couple of comments there. Firstly, the listed equity market, if you take all of the companies with more than 50% of their economic footprint in Africa, excluding South Africa, we calculated about $300 billion at the moment. So that's not insignificant in terms of the investment universe. Also, another point that's worth making is that if you're investing in companies like, for example, commercial banks, telecoms, industrials, you're actually getting quite a good look through into the underlying economy, into many of the companies that aren't actually listed.
All right, so obviously talking about commercial banks and telecos, energy companies also seems to be the fashionable investment area these days. When you're looking for yield, do you go into the conventional space that you've referred to, or do you look for companies just off the beaten track, sectors off the beaten track?
Yeah, we're not really focused on any particular sector. We tend to be long-term investors, and we purely focused on where we can find the best value. So whether that be in a utility company, a retailer, an industrial company, resources, financials, or telecoms, that's, we're absolutely indifferent to the sector. All that matters to us is the long-term total returns, including the capital gain or loss and the dividend yield that we're going to get from that investment.
I mean, with that sector agnostic approach, talk to us about your strategy. You talk about a strategy being growth focused, as you're saying, companies that have defensive cash flows, and then those dividend yields above 7%. That's breaking the international average. In South Africa, on a good day, yields could be nearer 3%, but we're actually looking at averages of just around 2%. So you're talking about yields above 7%. Where do you find these?
Yeah, I think you mentioned frontier and emerging markets earlier, and that's also something that really distinguishes the African listed equity market from those, is the valuation levels and the dividend yields. For example, if I gave you the top 10 dividend yields from our portfolio, they range between 7.5% and 12.5%. And these are for companies with excellent growth prospects going forward, which we understand quite well. So if you contrast the African listed equity market, for example, to the US at the moment, which is on close to 25 times its rolling one-year earnings, we're talking of closer to a price to earnings ratio of 10 to 12 in Africa listed equities, and with dividend yields in the range of 7.5% to 12.5% at the top end of the dividend yields. And those, if you say where do we find those companies, those aren't in any particular sector. Those range across the sectors that you mentioned earlier. And so we really take a bottom-up approach and try and spend most of our time in the countries actually speaking to the management teams and doing sort of quite detailed due diligence on the companies.
I mean, when we start talking about defensive cash flow, here's one of the biggest limitations in Africa: infrastructure and the cost of doing business because of this limited infrastructure. So a lot of companies can't preserve cash because they're always trying to get around the structural problems of the economy. And then there's the whole question of currency volatility, because for a lot of inputs, they've got to import them in dollars. Dollars quite volatile recently, but that's translated into volatile key currencies in Africa.
Yeah, I'll tackle the question on infrastructure first. I think what investors need to remember is that infrastructure bottlenecks are already in companies' historical performance. It's not like there are new infrastructure bottlenecks now. What's actually happening is the trend is positive in terms of infrastructure bottlenecks. So if you look at a country like Nigeria, they don't have to get everything right. Even if they get half of their infrastructure problems like electricity, transport, right, there's going to be a huge multiplier effect on the economy and on the listed companies in that geography. So a lot of the African countries are coming off quite a low base in terms of infrastructure, and we actually see that as net positive, because as the infrastructure is developed, so that will come out of the cost base of those companies and basically is borne by the government.
And finally, your exposure to North Africa, because most private equity flows have tended to be concentrated in North Africa. Most investors who speak of Africa as a geography are actually operating in North Africa. How has the situation of revolution changed the dynamic, if at all?
I think for active investors, any sort of disturbance like what's happened in North Africa over the past few months typically creates opportunities. You get stocks, for example, that were down 65 to 70% in Egypt and Tunisia, where they were trading considerably below the replacement cost of their assets. Now, in those cases, there are obviously stock-specific opportunities to take a material overweight position in a very high-quality company in a stock that has been sold down for whatever short-term reason. So typically, if there is political uncertainty, we often see that as an opportunity. Depending on which road countries like Egypt take, obviously there's a high road scenario, a low road scenario, and a middle of the road scenario. The democratic transition that's going on in that country at the moment can actually be very net positive in the long term.